Well, we used to make the joke that Series F stands for a bad word.
Right.
Because if you have to go that long, something is wrong with your company.
Ian Sigalow, managing partner and co-founder at Greycroft, thank you so much for taking the time to chat with us today.
Thank you for having me.
So if we could start with a more general question, and then we'll get more detailed. What's the size of the VC industry right now, and where has it come from, and where do you think it's going to?
So today, about $100 billion in the US of capital commitments annually into venture capital managers. Deployments vary, so there's dry powder that trails, but somewhere between 80 and 100 billion per year also. And on a global basis, it's probably, rough ballpark, 3 times that size. Mm-hmm. The US is the largest venture capital market in the world. China is the second largest. Europe is number 3. And then where is it going? So it's been growing at a fast clip. When we started Greycroft in 2006, I think it was 15 billion in the US. So it's compounding at north of 10% a year. I think it will continue to compound at 10 to 20% a year.
Am I right in saying is it the best performing asset class over the past decade?
Well, I don't know every asset class under the sun, but on an institutional basis, I believe it's the best performing asset class.
Now, in terms of process, in terms of owning the assets and finding an exit, I'm just talking simplistically. I remember there used to be seed round, A rounds, B rounds, but now there's A, C, D, and sometimes E and F rounds.
And G and H and I and J. Yeah,
it's getting longer and longer.
Mm-hmm.
So
the whole alphabet.
So what's sort of driven that change, and is the typical purchase to exit for VC funds getting longer, and do you expect that to continue?
Does
it depend on the IPO market?
Yeah, well, we used to make the joke that Series F stands for a bad word.
Right.
Because if you have to go that long, something is wrong with your company. What we've seen happen, and this dates back to the mid-90s, you may remember that when Amazon went public, they raised, I think it was $40 or $50 million at around a $400 million valuation. And the public markets played venture capital. And so you could, as a retail investor with an E-Trade account, get access to what today would be like that financing, 40 to 50 at 400 is like a Series B or Series C financing round. Mm-hmm. So that the market has changed dramatically, and companies that have the scale and size of Amazon at the time they went public are now being funded by venture capitalists. And as there's opportunity with these companies to generate alpha and to capture interesting financing rounds, it's just there's so little friction to go raise another Series C or D or E or F. So what's happened in practice is that the public markets, more and more companies look like Uber at the time they go public. Mm-hmm. It was $60 billion market cap, tens of billions of dollars of market cap. And the growth rates of those companies have slowed down a lot. And the return has been kind of consumed more by the private market investors over time. So retail investors are left with assets that are still growing, but are oftentimes significantly larger scale, more de-risked, at higher valuations as well.
So can you talk a little bit about the process of exiting? What are the factors that play a part? Does the general state of the stock market make a difference? How IPO appetite? What goes through your mind?
Some things we can control, and some things we can't control. So the challenge of being a venture owner is that you are a minority shareholder in these companies, right? So we're 10 to 20% of the cap table. Almost all of our businesses are founder-led companies. So when the founder determines it's time to sell, you're most often along for the ride. You do have the ability through stockholder rights and preferred shareholder rights to veto a sale, but if you shoot and you're wrong, because the founder knows more about the market and knows more about his or her own business than I do, it could be very expensive to be wrong, and reputationally expensive. So generally, the short answer to your question is when the founder says it's time to sell my company because pick a big strategic or private equity firm has shown up and made a really good offer, most of the time venture capital firms get in line. When it is time to go public, oftentimes the founder has a vision of running a publicly traded company, and they're really mission-driven people in my line of work. So they've got a point of view about, I want to build a business that will outlive me. And if you want to build a business like that, you're taking it public and you're investing in professional management. And then lastly, from the VC's perspective, we do guide the founders on this topic, but it is a form of soft power that we have to use sparingly.
It's pseudo-collaborative, but ultimately they have the final.
It's pseudo-collaborative.
As you look at your portfolio, what percentage are tech companies?
Virtually all of them.
Almost 100%.
Yeah. We have some consumer brands that are sold through retail. Part of our thesis on that topic is that you can build these cult brands. And even those companies, while they're built on Shopify, will have a CTO. But I wouldn't refer to them as technology companies. Virtually 90-something% of our assets, from healthcare to financial services to consumer internet, they're really software businesses.
And just to touch on regulation changes and how asset allocators think about allocating to the VC world, can you talk a bit about the regulation that's happening in the world of venture capital and whether that's a positive and negative for you?
So for us, it's a positive, but on the topic, so venture capital firms generally have been unregulated. We exist under the Exempt Reporting Advisor Act with the SEC. So as long as you comply with the broad mandate, you don't have to go through a formal SEC registration process. And even with that background, you should be operating in a compliant manner, and you're not excused from doing things. But the SEC tends not to go and investigate venture capital firms one-off. The industry now, unlike, for instance, a private equity firm or a hedge fund, the industry now is taking a closer look at this, and I believe that more venture capital firms will go down the formal path of registering as an RIA. And the reason why is it just opens up many more opportunities to scale your positions in portfolio companies. It opens up different dialogue with limited partners, because if you're a large asset owner and you're making a very significant investment in a manager, I think it's a helpful activity to know that that manager is being regulated by the SEC and that there's oversight. So as venture becomes more institutional, my guess is the bigger funds, those that manage a couple $1 billion and up, will go on to become formal RIAs. And it is expensive. I mean, the activity it's north of $1 million a year of additional overhead for that. But
did Sequoia say that they were going to go down that route?
So Sequoia is launching a hedge fund, or they're really turning their whole business into a hedge fund, if you read between the lines. But yeah, they're going down that route. Andreessen is, and then many of the other hedge funds that came into the venture world, so like Coatue, Iconic, Tiger, they're already registered.
I've heard you say before, which I thought was interesting, when asset allocators are looking at which venture capitalists to look for, is to strip out the best asset in their portfolio and strip out the worst one. Could you tell me, I mean, is that something you still stick by?
Look, at the end of the day, my money is in Greycroft, right? Because I run the firm. I have a couple other small friends who run small venture firms that I'll give them small amounts of money to. If you're a large-scale allocator trying to evaluate future returns in a manager, it is a really tough job in venture, because what makes a venture manager compelling to entrepreneurs over the course of decades is it's hard to pin down, because it's a very hand-to-hand combat, people-centric industry. And you've got to build technology, you've got to help companies scale, but it's sourcing and asset selection and decision making, and most managers truthfully don't have the ability to assess that, so they use consultants like a Cambridge Associates or a group like JP Morgan Asset Management that they'll go help us find managers and place some capital for us, or BlackRock. So if I'm looking at this from my lens, first off, I know virtually all the venture deals that get done, so I have a point of view on whether or not a portfolio is going to work. But if I didn't, and I was trying to come up with a more mathematical approach, I would remove in every fund the best and the worst and rerun the numbers, because at the end of the day, there's a certain amount of serendipity to portfolio construction. And if the difference between having that best asset or not was I didn't take the 2 train on a Tuesday because I would have missed a meeting. And that's the sole reason that my fund has performed, is that one deal. It seems to me that that would be beyond the scope of what would be predictive of future returns.
No, that's a great point. Let me ask you a more sort of macroeconomic question, if I may. We're in a world.
You may.
We're in a world where inflation seems to be sticking around and higher interest rates.
Yeah.
How does that affect the way you think about the outlook for VCs?
Well, it's the outlook for all investors.
Or market structure.
And market structure. So there is a meme going around, which is there's a guy sweating and there's 2 buttons. And button number 1 is hold cash and lose 8% for sure. And button number 2 is invest in the market and who knows what's going to happen. And I feel like people panic and they push button number 1, like I'm going to turtle and not make a decision for a year. But you're guaranteeing yourself that in real dollars you'll be down. And then once you get past the fact that this change is uncomfortable and you have to make rational business decisions about where to deploy capital, if you have the backdrop, and I personally don't believe, by the way, that inflation is permanently going to be at 8 to 10%. I think it's a blip, and we can have a longer discussion about that later. But if we're in an environment that over the next 36 months, say, that there's going to be accelerated rate of inflation, I think that you have to invest in assets that you believe will significantly outperform this new hurdle rate. So if your hurdle rate before was 6 or 7% or whatever in a 0 or 1 or 2% inflation environment, you should be adding some concept of kind of a permanent higher inflation on top of your hurdle, and look for assets that have the chance of generating a nominal return of mid to low teens as kind of your new hurdle rate. And if that's your lens, then you shift more of your assets into higher earning, but a different place on the risk reward spectrum. And I think that benefits venture as an asset class, given the general significant performance above the S&P 500 that the industry has enjoyed for the past 10 years.
I mean, I guess plus the fact that the 60 portfolio has had such a rough ride, and the increased, I think, interest in looking for alternative investments can only be great for the industry.
It's great.
Yeah. Well, seeing as you did mention inflation, and you said we can have a longer conversation about it.
Okay, go for it.
I would actually like to hear your views on it. So you think that we're here in a, let's call it mid-single digit inflation environment for the next 12 to 18 months, but you think we could be, it would be in the longer term, we're moving back down to a lower inflation environment?
If you pick apart inflation into its components, you have services and wages, and you have goods. And what we've seen in the US over the past year is services inflation has gone, if you look at kind of the structural elements dating back for more than a decade, we have been in a very low inflation environment because services have been 3% roughly and goods have been negative 1%, if not negative 2%. And that's before you get into this, and economists will talk about, it's not just substitution effects, but it's also the quality of goods. Like you can have all the 1940s medicine you want, but it's not going to heal you. And the quality of these products today are much better. I mean, iPhones, technology is driving a lot of this trend. I think that we get back on goods deflation that is more significant than 1% to 2% over the course of the next 3 years, because I've seen many supply shocks that were, where right now we have constrained supply. I believe there will be a glut that follows this.
Okay.
And I think services inflation has gone from 3 to 5%. you can sustain 5% services inflation if goods deflation is -10.
But what
and
about,
we could very well be in a scenario like that because there's a lot of supply being ramped up to accommodate the market demand right now.
do you think we're in a trend of deglobalization though? And isn't that sort of that is just like
I've written about this. This is the big point. So if you are a pessimist, and I'm not.
Me neither. For the record.
Venture capitalists are the ultimate optimists in the world. But if you are,
optimists live longer. It's a fact.
Fabulous. I won't sell my life insurance policy, but I'm excited about that. So the pessimists think that political factors will drive more protectionism and the unraveling of decades of globalism. And globalization in the current economy, it's the reason why Apple, Google, Facebook, Microsoft, all these companies are worth what they're worth because they've been able to grow so much faster than the US economy. They generate a majority, and it's not every company, but those companies I mentioned in particular, majority of their profits outside the US. And I believe that there is too much money at stake for that to revert. And as case in point, a friend of mine, Sir Ronald Cohen, who was the co-founder of Apax, he wanted to create peace in the Middle East. And he said the way to create peace in the Middle East is mutual economic prosperity. And if you travel, this is super, if you travel to Dubai, they have a lot of flights today to Israel. There were no flights between Israel and the Middle East a decade ago. And they've gone through open trade agreements. And I think just the connective tissue between the US and so many of our trading partners it's too expansive. There's too many dollars at stake, and everybody realizes, including in the US, that our own quality of life is dependent upon this status quo, not only remaining, but continuing to expand over the next few decades.
Do you believe in, he's come up a lot, but our friend Elon Musk, who believes that we are, the population is shrinking and it's a real problem that we are going to have a smaller labor force in the future than we do now, and that's a possibly very sort of wage inflationary pressure?
I think more developed societies generally have a lower birth rate, which results in a slowdown of population growth. I think the population in the US is growing, but it's not growing as fast as sub-Saharan Africa, and it won't. But we need fewer people to generate a unit of economic output today than we did 50 or 100 years ago, and that will continue to change and move in that favor. The contrary points, more and more people are moving to metropolitan areas. The amount of goods and services and energy required to support somebody when they live in a high rise is lower. So there are really big systemic factors that will enable our society to continue to flourish even if the birth rate slows down to 1% to 2% a year. I don't lose a lot of sleep over that.
I feel like I could ask you
and robots are coming, of course, so we can talk about that too.
They may already be here.
They're already here.
Maybe I can ask a last question. It just sort of popped into my head when you talked about these huge, global phenomena like Apple and Google and Facebook. Do we need to readdress what a sort of standardized global corporate tax rate? Is that something that you think will come in, and what kind of harm could it do?
Wow. Well, they've tried. And I say they. It's like the, what is it? The top 20, something 12 and the something 20 have gotten, yes, exactly, have gotten together to try to create, this global tax scheme. It's not going to work, but I don't think it's necessary either. And ultimately, U.S. and Europe and big economies all have pretty similar tax structures at the end of the day, and it was a different case in point if you had Ireland, which is part of the EU, say, oh, there's no corporate taxes, but they're not going to let that happen anymore. So ultimately, if you want access to the big global economies, you're going to play in a tax scheme that looks very familiar.
Right.
The separate part of this is that in the United States, there are certain people on certain far ends of the political spectrum that would very much like to see the US take either a much higher or a much lower set of taxes. But you give up some tax sovereignty when you agree to a global scheme. And again, I think just the money is too big to ultimately change that paradigm. And even people who have really strong, almost religious beliefs around what the tax rate should be for a company, they'll be persuaded.
Yeah. Well, Ian, as I say, I could chat to you all day, but we only have a certain amount of time. And I want to say thank you so much for your insights today. It's been great.
Thank you for having me.